In this week's update, the merits of switching off from the noise, how to stop interrupting your wealth building, roadmap for the next few months, and new trends in gold. My name's Garry Davis. As always, this is general advice only, and please remember to like and subscribe to the video. What are we? Incredible roller coaster of price action, emotion, anxiety. It really had it all, and in the end, the S&P ended up flat. So a lot of movement over not very much. So what does it actually mean when you can stand back and take stock of a week like we've just had, where we got a crash in Tokyo, the Nikkei down nearly 12%? And it just tells you that in this day and age, in modern, very interconnected financial markets, that selling spirals can start from not a great deal. And in this case, there was a couple of isolated data points that were untested. They were yet to be validated as new trends, but the market reacted to them quite badly. And I'm not saying that there were absolutely no background circumstances, because the Bank of Japan put up their interest rates from effectively 0 to 0.25%. But I don't know how the yen carry trade is going to progress from here, but certainly the fear over a US recession was completely unwarranted at this point in time. Now, the US economy may end up in a recession next year or the year after. I mean, the US election is a complete mystery, and what economic policy stems from that is an unknown. But right now, here today, the US is not headed towards a recession. And so a good part of what happened in the early part of last week was completely unnecessary. And the point about it is that it's impacted a lot of investors' plans and processes, just completely thrown them up in the air because people have overreacted. So it was another lesson in learning to underreact to single data points. You know, it really is such a key lesson. And if you can take nothing else away from what happened last week, it's that one. Just sit back and watch. And from some very hard-won experience and perspective through my more than 3.5 decades in the market, the majority of, whether you're a shorter-term trader, and shorter-term traders particularly know this lesson, and that is that you make the majority of your profits and progress from a relatively small number of trades. And it's the same with long-term investors. The vast bulk of your wealth creation comes from a small handful of stocks that you stay with, and you give the story a chance to unfold over multiple years. So if you accept that that is an absolute truism that's probably never going to change, and the fact that those particular stocks, and I'll show you a few in just a minute, deliver absolutely huge returns over long periods. We're talking 10, 20, 30, sometimes even 50 bagger results over a decade or perhaps 2 decades, then they are completely life-changing. They are completely wealth-changing. And so if you try to dive in and out of those kind of stocks, then your results are going to be impacted massively. It's not just a few percentage points worse performance. It is a massive difference. It is a life-changing difference. So you've got to learn to stay the journey with the right kind of stocks. Now, I'm not intimating that you just sit and hold on everything, because chances are you will have quite a few lemons. We all will have quite a few lemons, because stories change, circumstances change. There's only a small number that go on to be the really great stocks. So you've just really got to examine the process of management that you're using. So what happens when you fall over the cliff with all the other millions of lemmings, as occurred last Friday and Monday and Tuesday? Well, you just interrupt the process, because you will either not get back in, because when you think about it, if you've just crystallized a loss on a stock, you are going to be that much more reticent to get back in again. you're going to need that much more proof that this thing has turned around and it's going up. So your psychology is going to require, more time, more information, more validation. And so the two outcomes which are highly likely is that you'll neither not get back in at all, so you would have only partially captured what was going to be a really, really big multi-bagger, or the vast majority of the time you'll end up paying probably significantly more than the price that you got out at. Because again, just think back, step back and think about this perspective. And that is, if you've got a really good stock where the business is going to continue to grow and earnings are going to grow and the valuation is going to go up over time, then the lower the price that you're selling at, isn't that closer and closer to a point where you would want to buy? So I really don't understand the motive. Oh, yes, I do. It's just emotion controlling the situation. So you just need to step back and ask yourself, if this really is a great stock, if earnings really are set to continue growing at a strong rate over the long term, then the fact that the price has just fallen 20% means I'm actually getting closer to a buy, not closer to a sell. So I'd really like everyone just to step back and just spend 5 seconds and reflect on what they actually did last week and whether it was, necessarily warranted and the right call. So to avoid falling into that same trap, succumbing to emotions and doing it over and over again, just think about how you reacted last week and use that as a learning point for the next time, because there will be a next time. There will be hundreds of next times. So you want to really take last week as a great learning exercise. And the way to proceed is that you've got to work towards building confidence in the process that you're using. Now, if you don't have a process, then you're in a lot of trouble. And, the market's just going to have its way with you. But you've got to have a process. And then you've got to execute to that process for long enough to build confidence so that when we encounter situations like we had last week, that you definitely underreact. You need a means, so beyond that, and to help build that confidence, you need a means to continually have your perspective refreshed. Unless you're immersed in the market, it's very easy to be sidetracked by the media. Again, just think about what you got hit with in the early part of last week. The media was absolutely going nuts, and it was very easy to be influenced by that. So you continually need to have your perspective refreshed, because otherwise you're making decisions that you think are logical and they seem fair enough. But a week on and you realise that would have been a big mistake. And of course, once you get to this point where you're confident that your process will see you through, now, it doesn't mean that every decision you make is right, far from it. But if the majority of the decisions that you make are in your best long-term interest, then that helps with retaining patience and not overreacting to the sort of situation that we had last week. So at the end of the day, so all part of this confidence building cycle, someone needs to do vast amounts of research to make the process work. It's either you or it's someone else that you utilize their expertise and their effort in doing the hard yards and doing the research to find out what are the stocks that are likely to be these great long-term winners, the ones that are highly likely to produce 10, 30, 50% or 50 bagger gains, I should say. So let me just show a couple of examples, and these are ones that will be familiar to everybody. This is CSL. Since 2011, this has been a 10 bagger, despite the fact, and if for anyone that hasn't heard that term, that means it's gone up 1,000%. gone up 10 times what you originally paid for it, despite the fact that it's done nothing for 4.5 years. It's just gone sideways. And it's still delivered a 10-bagger since 2011. PME has been a 50-bagger since 2015 and an 8-bagger since 2020. These are enormous wealth-changing stocks. Apple has been a 15-bagger since 2012. Microsoft has been a 14-bagger. You will not get these results if you're trying to keep diving out of the market every time it flinches. So, you're doing yourself a great disservice by doing that. So hopefully this message is coming through loud and clear. And I was so keen to present this because it's not often that we get a week like we've just had where it plunges and then it recovers all in the 1 week. Normally that's spread out over a month. But to see all of this action in 1 week where we can recall what it was like on Monday and we can recall what it was like and how we felt on Friday, you rarely get that opportunity to have all that emotion condensed within the 1 week. So that's why I'm sort of laboring the point on this. It is such a powerful learning exercise. So getting back to what I was saying, someone needs to do the vast amount of work, and it is a vast amount of work. You don't get across the PMEs in the early days or the CSLs or the Microsofts unless you've done a vast amount of work to really understand the business and understand where it's going. So someone's got to do it. So if it's not you, and for 99% of people, it's not you because you don't have the time, you don't have the focus, you have the interest, and you probably don't have the knowledge to do it with the depth that's required. So if it's not you, then whom is going to do it? Because someone's got to do it. And I talk to people who they dabble in their investing. They just do a bit of research here, a bit there, a couple of tips here and there, and just cobble it all together. It just doesn't cut it. It's not going to get you there because it's not going to allow you to build the confidence that you need to get through a week like we've just had and to get through a week in good shape. Okay, that's the key message of this week. Hopefully everyone's got it. The S&P ended up flat across the week, amazingly. That was inconceivable halfway through the US session on Tuesday. The NASDAQ actually went up by nearly 0.5%. So amazing outcomes given the way the week started. The RSP, the equal weight S&P, was also flat. Small caps did go down 1.2%, and that's pretty normal because whenever there's an upheaval in the market, small cap stocks get treated poorly because they're perceived as less resilient. So again, to me, that's not a trend. That's just 1 week. I think the rotation from larger cap tech stocks in the smaller end of the market where you've got high growth, but you've also got value because they've been out of favor for so long. So much money and attention has gone on to the big tech end of the market and AI. Now, when I look at the indices, they're not offering me any clarity at all over what comes next. I just have no feel, I have no opinion for where the indices go. And one of the reasons for that is that if this rotation continues, and I think the overwhelming odds are that it will, that means that the big tech stocks are going to continue to be, they mightn't go down, but I doubt very much they're going to go up. So they're going to continue to experience a degree of pressure. And that pressure is going to have an adverse effect on the indices because they dominate the indices. So I can actually see a scenario where the indices can go down, but stocks that we're actually invested in can actually go up and go up significantly because there's been some fabulous outcomes. In the Insiders Club US portfolio, we've got a number of US stocks that have, and whilst the price responses in the short term have been mixed, a couple have been good, a couple have been not so good, but the earnings and the outlooks look fantastic. And they're the stocks that are going to I think, do really well, despite the fact that the US indices might actually go down. So, again, don't confuse the indices going down with the opportunities in the marketplace. Just focus on the stocks that are delivering great earnings, they've got solid outlooks, and they've got strong runways for growth, because within that group, there will be the next CSLs, the next PMEs, the next Microsofts. You just need to own a cross-section of those kind of stocks, and one or two will emerge, and they will change your wealth situation significantly. But you've got to learn to stay the journey. US dollar index was down 103.15. The 10-year yield fell below 4%, got down to about 3.8, and then jumped back to almost 4. We saw a lot of upheaval across all asset classes, not just equities. The VIX spiked on Monday to 65 when the Nikkei fell 12%, which was ridiculous, because they're the levels that we've only seen twice this century. Once was in 2008 and once was with COVID. And the situation we had last week was nothing like what happened in those two situations. So it just shows you just how enormously emotional the market got and how misguided the market got. And it fell all the way back to 20. And again, it's not what you see in 2008 and in COVID. They spiked to above 50, but they took months to come back below 30. The VIX has come straight back down, almost to where it's been running for most of the last couple of years. So an absolute roller coaster in the US, as it was pretty much everywhere. So let's go and look at some of the charts. Is the S&P on a weekly, huge gap down on the Monday. And from there, we did have a little bit more. So big gap down on the Monday. And then from there, we went up a little bit on Tuesday, bit of a rethink Wednesday, but then the rest of the week ended up pretty positive. And you can see closed not that far off the session highs. So that was a pretty positive outcome for the S&P. If we look at the RSP, very, very similar, but a bit less in terms of the magnitude of the fluctuations. And this was IWM. We recovered after Monday's plunge, but Monday's plunge had well and truly done the damage. NASDAQ also managed to make a small gain, just creeping back above this support and resistance line. So that got well and truly smashed on Monday, but the rest of the week was a recovery. I said last week that semiconductor index SMH will get sold off. It will be overdone, but get prepared for the opportunities. I don't think we're there yet. I don't have enough confidence that the semiconductor sector has yet gone as low as it might go. But semiconductors are not going away. AI is not going away. All that's happened here is that there may be some slowdown in demand for semiconductor chips. Maybe the Googles and the Amazons and the Metas of the world have spent too much money too quickly, and demand for semiconductors might cool off a little bit. But the long-term story is not changing. So there is an opportunity building here, and we've just got to remain patient to get a setup which has a lower potential downside risk and therefore a higher potential upside risk. That's all we're trying to do in the market, is just trying to wait for entry points where there's relatively limited downside potential, but there is very significant upside. And if you just keep doing that over and over again, you'll be well and truly in good shape. Now, NVIDIA has bounced back. There's still a lot of discussion about the valuation of NVIDIA. I don't actually have a problem with the valuation of NVIDIA. Yes, the price might go down. And yes, their financials might get impacted a little bit. The rate of growth might slow significantly, but it's been meteoric. It could slow significantly and still be really, really good. And I don't think NVIDIA with PEs in the low to mid 30s is is overvalued. Would I buy it today? No. But am I going to buy it in the future if I can get the right setup? Absolutely. Because this remains a fantastic long-term wealth-creating business. That's the semiconductor sector, SMH versus the S&P, and there's definitely a character change here. There's no question. That ratio between the two has dramatically shifted. What we don't at this stage is how much further down. So keep it on your radar. Be patient. There's an opportunity building. Over the last month in the US, we've ended up with healthcare being on top along with staples. So that all makes sense, followed by finance. Then we've got materials and energy sitting there in the middle, and all of the aggressive sectors, consumer services, discretionary and technology are bringing up the rear. So no real surprises there. So huge plunges in those indexes, but then equally a pretty decent bounce back in the last part of the week. Australia, not dissimilar, healthcare, finance leading the way, small caps doing okay in Australia. And then we've got materials and technology and energy bringing up the rear. So that's how things looked in America. In Australia, our dollar bounced with the US dollar going lower to back above 65. Our index ended up down 2.1% across the week, but with the jobs data coming through more positively, which allowed the US market to rebound on Thursday and Friday, I will be surprised if the Australian index is not probably at least 1% higher on Monday. So we saw huge damage early in the week and then a partial recovery towards the end. But the scoreboard shows that energy was down 7%. It was the worst. But IT was also down by 6.3% and was down a lot more than that before we came into Friday. All right, precious metals now. Gold was down $10 to $24.33 in Aussie dollars. That lost a little bit of ground in Aussie dollars, but still above 3,700. So still in very, very good shape. Now, we're seeing a character change in the ETF market because money has been flowing out of gold ETFs for a long period of time. But we've seen now 3 successive months of inflows to gold ETFs, and there was $3.7 billion flowed into gold ETFs in July, which was the strongest in more than 2 years. So that's a really good indicator, and the third consecutive inflow. When we look locally, mergers and acquisitions continue to dominate the scene. There's still concerns around the costs of production, whether it's gold or whatever material it is. Costs are still definitely a problem. But M&A is continuing to bubble along, and those stocks that have got the best strategic position, if you like, for varying reasons, are the ones that are very much in focus. So let's go and look at the gold market. So there's gold on a weekly chart. Unquestionably, there is an uptrend. You don't need to know anything about gold or anything about markets, to be honest. You just got to look at that chart, and that tells you that we've got a very strong uptrend that started back in 2022. So nearly 2 years ago, the market has been moving higher. It broke out of this long range that had been building for a couple of years, broke out in March of this year, shot up very, very quickly over a period of about 5 weeks, has sort of cooled down a little bit, but we're still pointing to the upside. There's no question about that. Silver was looking good, broke out. The narrative around silver was very positive, but once again, and this has been happening now year after year after year, where the expectation has been that silver would start to perform, and it never seems to get there. So it's a tough space, the silver space, that's for sure. And if we look at a relative comparison between gold and silver, then we've seen that's an extreme develop here with silver doing well for a relatively short period, but things are, coming back to where they normally have been sitting. Turning to other commodities, copper was down to $3.98, so under $4, and that was very unexpected just a couple of months ago when you looked at where the price chart was at $5. Nickel was at $7.28, still struggling. So copper, as you'll see in the chart in a minute, has had a rapid plunge down to support. I'm struggling with finding any appeal. As convicted as I am about where the copper price will be in a couple of years' time, I find very little appeal in local copper producers. Haven't owned any local copper producers for quite a few years. We've got production issues in a number of places. We've got valuation issues because the current valuations are being framed on copper prices that are above $5 a pound. And that's where we were a couple of months ago. But as you'll see, we've fallen away from that quite dramatically. So those current valuations do not reflect the trends that we have at the moment. And then when you drop down to the developers stage, there's not really very much other than a few very stock-specific examples. In general terms, stocks that are developing copper resources are really just being swallowed up in concerns about will the project get funded or how much dilution will be required before they can reach profitability. And so there's very little to get excited about. So, it's not what we expected a year or two ago when all the hype was around critical minerals. It just has not played out the way that anyone expected. West Texas Intermediate crude rose to almost 77. There's the copper chart. So you can see in the early part of June, we were trading over $5, and now we've dipped under $4. Hopefully this is the low. Hopefully this is support here around $4, and the copper price bounces from here. But there's a couple of realities. One is that the stockpiles in China, copper stockpiles in China, are rising and have risen quite a bit because demand has fallen away. So that is definitely impacting on the copper price. And then there's these fears over recession not only in the US, but globally. So it's not a particularly enthusiastic outlook for copper just at the minute. And there's the crude oil price. It's been pretty volatile, but 70 to 90 is the range. There's no reason to suspect that it's going to move outside of that. But again, as with minerals in Australia, I'm finding it, and have been finding it for many years, very difficult to get enthused about the energy sector in Australia. Wrapping it up, how to go about getting far better long-term results, well above average results. And the first thing that you've got to do, and this is really the big lesson from last week, is to tune out the noise. Just ignore all that stuff. Just, don't read the popular press. Have a broad cross-section of different sources of information from independent analysts that don't have a particular case to be made in either way. Just tune out all the noise. Only pursue proven quality stocks, the stocks that have got the characteristics that could lead them to be the next CSL or the next PME. Now, if you went out and bought 15 of those, you'd probably only get one or two that would actually end up being of that stature. But that's all you need. So you just need, if you only put those kind of stocks in your portfolio, then you're a very good chance of getting that one or two. And just forget the rest, forget the maybes, the ones that might pay off big time. If they don't have all the key foundations that makes these great stocks, then forget them. Not worth having. The next thing you need to do is to make sure the research is thorough, because the only way you can determine whether these stocks are a likely future PME is to do a great deal of in-depth research. And then you've got to give the story time to unfold, because markets misprice these quality stocks constantly. They misprice them as often as they misprice rubbish, which is often priced to the upside. So you got to give it time to unfold. And sometimes that time might be 2, 3, 5 years. But it's the result of that, that unfolding is where the money is. Portfolio analyst last week, it was what I do the first week of every month, and that's an educational session taking stock of things that have been discussed, decisions made, etc. What can we learn from it? And the key part of that edition was just gaining clarity around your target stocks. How do you do that? How do you build confidence that this particular stock has a better than average chance of being a superstar? So it was a good session. There is more information on the website, and there's my email address, and I'll be back with you next Sunday. Cheers.